Welcome to the deep dive. You're here because you're serious about understanding commercial real estate and, well, let's be honest, about seeing a real return on your investment.
hmm
We're cutting straight to the chase today with a really critical question. Are we talking about your initial capital doubling, maybe even tripling?
That's exactly the level of insight we're aiming for. And to get there, we're dissecting the equity multiple.
Okay.
It's a cornerstone metric in commercial real estate, really reveals the total profit potential of a deal.
Our roadmap for this deep dive comes from the expertise of Cara Conde, a commercial real estate agent based right in Indianapolis.
Right. Boots on the ground perspective.
Exactly. And while national headlines focus on bigger markets, Kara's experience and data really highlight Indianapolis. It's a compelling area for commercial growth, retail, industrial, office properties.
It really is.
Did you know, for instance, Kara shared a report showing warehouse lease activity in Southeast Indy jumped, 18% last year alone? That's the specific insight we're tapping into.
Yeah, and that firsthand perspective in that specific market makes her insight so valuable. Her data-driven approach lets us move beyond just general ideas.
Right, get to the tangible potential.
hmm
So our goal today is pretty straightforward. By the end of this, you'll not only grasp what the equity multiple is,
That's right, yeah.
but also understand why it's such a vital tool for evaluating deals, how to actually apply it, and how it fits with other key financial indicators.
And we'll keep looping back to Indianapolis using Kara-specific knowledge.
Perfect. Okay, let's unpack this.
Yeah.
Just what is the equity multiple in commercial real estate?
Okay, simply put, the equity multiple measures the total cash return you get back on your initial equity investment
Okay.
over the entire time you own the property. It basically answers, how many dollars did I get back for every dollar I put in?
So if I invest, say, $100,000 initial equity and the equity multiple is 2x, that means I get $200,000 back total over the whole investment life.
Precisely. The calculation is direct. Equity multiple equals total cash distributions divided by initial equity investment. Simple math.
Total cash distributions. What does that include exactly?
Right, so that's all the cash that flows back to you. Your regular rental income, any money from refinancing the property,
Ah,
and importantly, the net proceeds when you eventually sell it.
got it. The sum total of cash out. And the initial equity investment, that's the upfront money.
Exactly. Your capital right at the start.
Mhm.
Usually the down payment, closing costs,
Right.
and any immediate money spent on like initial renovations or improvements.
Okay. Cara's article had a really good concrete example, based in Indianapolis, I think.
Yeah, the office building one.
Right. Investor puts $200,000 into an Indy office building.
hmm
Over 7 years, they collect $150,000 in net rent. Then they sell for $350,000.
Okay.
So total cash back is $150,000 plus $350,000. That's $500,000.
Exactly. And you divide that $500,000 total cash distribution by the initial $200,000 equity.
And you get 2.5x.
2.5x. It clearly shows the investor got back 2.5 times their original $200,000 in cash.
Okay, that paints a clear picture. So why is knowing this 2.5x figure so crucial? What does it really tell an investor?
Well, it gives you a really straightforward look at the overall profitability of the whole venture, start to finish.
Unlike metrics focused on, say, just 1 year.
Exactly. This gives you the long view. It's especially valuable for evaluating deals with longer hold periods.
But there's a catch, right?
There is. As Cara points out, it doesn't account for the time value of money.
Mm,
Getting 2.5x back over 20 years is, obviously not the same as getting it in 5.
right. Speed matters.
It does. That's why you almost always look at it alongside other metrics. But in a market like Indianapolis, which is pretty dynamic,
Mhm.
with different property types and investment timelines, just knowing that total potential return, the equity multiple, is the fundamental first step.
Mm.
Helps compare deals, set expectations.
Okay, so it's the big picture on profit, but not the speed of that profit. Which brings us nicely to comparing it with other metrics, like IRR, internal rate of return.
Yeah, IRR. Big difference there.
What does IRR tell us the equity multiple doesn't?
IRR focuses on the annualized rate of return. It specifically factors in the time value of money.
Ah, okay.
So while equity multiple gives you the total times your money back, IRR tells you the average annual percentage return you earned over that time.
So going back to that 2.0x equity multiple example, if I get that over 10 years versus 5 years,
Right.
the IRR would be lower for the 10-year deal, even though the total multiple is the same.
Precisely. Cara highlights this really well. A 2.0x over 10 years is just less efficient. Your money's working slower than the same 2.0x in 5 years.
Makes sense.
The IRR calculation shows that clearly. lower annual percentage for the longer hold. And at a place like Indy, where timing and market cycles matter,
Sure.
you really want both a good equity multiple and a strong IRR. Cara helps clients balance those.
Okay, so total return versus the time-sensitive annualized return. Got it. Now, how about cash-on-cash return? Where does that fit in?
Cash on cash is much more immediate. It looks specifically at the annual cash flow the property generates compared to your initial equity.
Like year one income versus initial cash put in.
Exactly. If you put in $100,000 and get $10,000 back in net cash flow the first year, your cash-on-cash return for that year is 10%.
So it's very focused on the now, the annual income stream, whereas equity multiple is looking at the whole picture, sale included.
That's it. Equity multiple includes all cash flows, including that big payout at the end from the sale, usually.
Right.
So equity multiple is better for judging the overall success of the entire project, start to finish. Cash on cash is great for assessing immediate income potential and tracking annual performance.
Okay, let me see if we've got this straight. Equity multiple. Simple, shows total return but ignores time.
Yep.
IRR accounts for time, shows annual efficiency but maybe a bit more complex to calculate.
Right.
And cash on cash focuses on the here and now annual income.
You got it.
So it really sounds like you need all three for a proper look at a deal.
Absolutely. That's a key takeaway from Cara's approach.
Yeah.
Using them together gives you a much more robust framework for making decisions.
Especially in a diverse market like Indianapolis.
Exactly. You need the total gain potential,
Mhm.
equity multiple, the speed of those gains, IRR, and the immediate income, cash on cash. It's the trifecta, really.
All right, so we understand what it is, how it stacks up against other metrics. Now, the practical side. How do we actually use this equity multiple when looking at deals? Especially thinking about Indianapolis.
Okay, yeah, it becomes a really handy tool in a few ways. First, as Cara points out, it lets you compare different potential investments directly.
Apples to apples, sort of.
Kind of like, say you're looking at a retail project in maybe Carmel, projected 2.3x equity multiple over 6 years
Okay.
versus maybe an industrial building out in Plainfield, projected 1.9x over the same 6 years.
All else being equal, the Carmel deal looks better from a total return perspective.
Right. Higher multiple. And this is where Cara's local knowledge comes in, knowing which indie submarkets are hot for which property types. That helps pinpoint those higher potential deals.
Yes. Makes sense. A quick check on overall profitability. What else? How else is it used?
You also use it to set targets, your own benchmarks and goals for an investment.
Ah, like what a good multiple looks like.
Exactly, and that varies. Different property types, different risk levels, they'll have different target equity multiples.
Give me an example.
Sure. A lower risk, stable property like a Class A apartment building,
Yep.
maybe you're aiming for 1.7x to 2.3x, something like that.
Okay, pretty standard return.
But then a riskier deal, like a value-add project, maybe turning around a struggling shopping center,
Yeah.
you'd target a much higher multiple, maybe
Mhm.
2.5x to 3.5x, or even higher, to compensate for that extra risk and work.
And how does the Indianapolis market itself influence those targets? Is Indy different?
Well, Cara notes that Indy is seeing really strong growth in certain sectors right now. Logistics, distribution.
Mm-hmm.
That's booming because of its location.
Right, the crossroads of America.
Exactly. So that strong demand might mean investors target and maybe even achieve higher equity multiples for industrial projects there compared to other places.
So you adjust your expectations based on the local market heat.
You have to. Cara emphasizes using current local data from firms like CBRE, JLL, Colliers to set realistic benchmarks for different property types in Indianapolis.
Right, so an industrial deal near the airport might have a higher target multiple than something else?
Yeah, quite possibly. Especially a value-add warehouse in a prime spot there right now, the potential might justify aiming higher.
Cara's article also had that case study, the warehouse investment in Indy. Can you walk us through that one? How did the equity multiple work out?
Sure. So this client, working with Cara, put $300,000 equity into an Indianapolis warehouse.
Okay, $300 fee in.
Over 5 years, they collected $200,000 in net rent, and then they sold it for $460,000.
So total cash out is $200K plus $460K, $660,000.
Right. So you take that $660,000 divided by the initial $300,000
And
investment.
that gives 2.2x.
2.2x equity multiple over 5 years. A solid return.
And Cara mentioned that negotiating a good purchase price at the start was key to that.
Absolutely critical. Getting the property below its intrinsic value up front, that immediately boosts your potential multiple when you sell.
Creates instant equity, in a way.
Exactly. Cara's market knowledge and negotiation skills in finding and securing that asset in Indy's industrial corridor were huge factors in its success.
Okay, so for someone really looking to maximize their equity multiple in Indianapolis, drawing on Cara Conde's kind of expertise, what are the main strategies?
Well, Kara highlights a few key things particularly relevant for Indy. First, location, 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 right? Focus on high-growth submarkets.
Where specifically in Indy?
She points to areas like downtown for office space, certain suburban retail spots like maybe in Fishers or parts of Carmel that are holding strong,
Uh-huh.
and very important, those industrial zones near the main highways, I-70, I-465. Logistics is just huge there.
So finding where the demand is highest for both rent and future appreciation.
Exactly. Kara's local knowledge helps guide clients to those pockets with the best potential for both cash flow growth and appreciation.
Makes sense. What's strategy number 2?
Negotiation. It's
Mm.
huge, getting that initial purchase price right, like we just talked about,
Right.
but also negotiating favorable lease terms with tenants. Strong leases mean reliable cash flow, which supports the overall return.
And Cara has specific expertise there.
Yeah, she's actually certified in negotiation. It's a real advantage when hammering out those deals.
Okay, location, negotiation. What's the third key strategy for indie investors?
The third one Kara emphasizes is seeking out value-add properties.
Meaning?
Assets that are, currently underperforming, maybe they're dated, maybe management hasn't been great, but they have potential.
Untapped potential.
Right. So you come in, you invest strategically in renovations, upgrades, maybe reposition the property entirely to meet current market demand.
And that boosts rents and the final sale price.
That's the goal. Significantly increase both rental income and the eventual resale value. Kara's got a track record of finding these kinds of opportunities in Indy and its suburbs.
And it sounds like this approach works. Her article mentioned a client who did well with this.
Yeah, there's a client testimonial about an industrial property in Indy. Delivered a 2.3x equity multiple in just 5 years.
Oh, wow.
And the client specifically credited Kara's market knowledge and negotiation skills for hitting that strong return.
Okay, so for listeners active in Indy or thinking about it, Cara's website is caraconde.com, and the phone number is 317-999-9888. Good resources for that local expertise.
Definitely worth checking out if you're serious about that market.
Now, even though equity multiples seem simple, there must be common mistakes people make, right? Pitfalls to avoid.
Oh, absolutely. It's a valuable tool, but you can definitely misuse it or misinterpret it.
Like what? What's a common error?
One big one is just being too optimistic with your projections, overestimating future cash flows.
You mean predicting rents will be higher than they realistically will be, or the sale price?
Exactly, rose-tinted glasses. It leads to an inflated, unrealistic equity multiple on paper. Cara always stresses grounding projections in solid market research.
Using real data.
Yes, data from reliable sources like CoStar, LoopNet, or local indie market reports. Keep it realistic.
Okay, avoid overly optimistic projections. What's another pitfall?
We touched on this, but it bears repeating. Ignoring the time value of money.
Right, the when matters.
Hugely. A 2.1x multiple might look okay, but if it takes 15 years, that's way less attractive than getting, say, 1.9x in 5 years.
So you absolutely have to look at it alongside IRR.
You really should. Cara consistently advises using IRR too. It
Yes.
gives you that crucial context of how efficiently your capital is working over time. It's about finding that sweet spot, good total return in a reasonable time frame.
Okay, time value is key. One more common mistake.
Misjudging market trends. The real estate landscape, even within Indy, changes constantly. Well, you could have oversupply pop up in certain sectors. Maybe, hypothetically, too much suburban office space gets built in one area.
And that pushes down rents.
Exactly. Puts downward pressure on rents, maybe hurts occupancy, and ultimately drags down your overall return and your equity multiple.
So you need to know the local supply and demand dynamics.
Precisely. A good local expert like Cara has access to current data, knows what's happening on the ground through her network. That helps guide clients towards sectors with strong fundamentals and away from areas maybe facing headwinds.
Got it. Stay informed about the specific indie market, not just general trends. Local knowledge is indispensable.
Couldn't agree more. It really is key for maximizing that potential equity multiple.
This has been a really insightful deep dive. To wrap it all up, what are the main takeaways for our listeners?
Okay, I'd say number one, equity multiple is a fundamental metric. It shows the total potential return on your commercial real estate investment. Super useful, especially in a dynamic market like Indianapolis. But number two, remember its limitation. It doesn't account for time. So you absolutely must use it with other metrics, especially IRR, maybe cash on cash too, for the full picture.
Get that comprehensive view.
Exactly. And third, Partnering with a local expert, someone like Cara Conde in Indianapolis, it'd be incredibly valuable.
How so, specifically?
Well, for strategic property selection in the right submarkets, for strong negotiation, and just having that up-to-date market knowledge, it all helps maximize your equity multiple potential.
Whether you're looking at retail in, say, Broad Ripple or industrial near the airport.
Yeah, exactly. That on-the-ground expertise can really make a difference in your investment outcomes.
So, as you listeners evaluate your next commercial real estate deal, definitely consider the equity multiple. Ask, what's the total potential return here? And maybe think about connecting with a professional like Cara Conde, if Indianapolis is your focus, to really dig into those local market specifics.
Understanding this metric and its context is definitely a big step towards making smarter, potentially more profitable investment choices.